Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
All right, let's get to what you really want to hear about, and that is, of course, the Fed decision today. Fed Chair Jay Powell in his press conference after the decision, highlighting that labor conditions are pretty close to max employment and yet continue to cool, which has been a plus to inflation.
Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures.
Bringing us now, Ira Jersey. He is the chief U.S. interest rate strategist at Bloomberg Intelligence. Brent Schutte is the chief investment officer at Northwestern Mutual Wealth with us as well. And Ira, let me start with you. Listened to you before this announcement was made today, kind of followed along on the Top Live blog as all of this unfolded. You were not one who was, shall we say, enthusiastic about this 25 or 50 betting game that was happening over the course of these last many days. What stood out to you, both from the statement that we got today and what Fed Chair Powell said there at the end? I was saying just a moment ago, he was quick to say that, this shouldn't read this as gospel, what the Fed intends to do here as the year goes on.
Well, that's always been the case with the dots, particularly since they've been changing them quite frequently at just about every single quarterly update that they do with that dot plot. But I think the near-term dots, when you think about November and December's meeting, they made it pretty clear that unless something significantly changes with the trends in the economy and inflation, that you're likely to see modest cuts going forward. So 25 basis points over the next couple of meetings. But I think that's less important to me. What I was focused on was what they said where they said they were going to ultimately, and where they think they're going to, even with the economy not hitting into a recession, is all the way down to under 3% on the Fed funds rate. And the market was kind of bifurcated and remains bifurcated in thinking maybe the Fed's only going to cut to 4% or the Fed's going to cut to 2%. And the Fed decided just to take the middle ground of that and say, hey, well, what do you think about 2.5%? The way they get there, Fed funds rate at 3% and inflation at about 2%. You're talking about a 1% natural funds rate. And when you look at some of the models they use, that's just about where they where those are saying the neutral policy rate should be.
I got to just follow Ira. It felt like a little bit of a surprise, at least for me. I know the debate that was going on, it was kind of, we just couldn't talk about it enough. But it did, when I saw the 50 basis points, I kind of yelled out in the newsroom, like, oh my God, is there something coming undone? Financial market conditions I thought were pretty okay. Like, economy's still growing, corporate profits maybe not as upbeat. Like, is something wrong that we're missing, or what was the thinking behind the Fed?
No, and there was actually a question in the press conference to Chair Powell just about that. If they had the August payroll report, would they have cut in July at the July meeting? And he said he didn't know, but maybe, right? So and that's kind of how I'm taking this 50 basis point move. It's more, hey, we probably should have gone in July. We want to go slow, so let's do 50 now to kind of catch up to where we think we're going to have to be. But importantly, and as you guys mentioned, as Dave just mentioned, before what I said yesterday was, look, I don't care about 25 or 50. What I care about is what does he say after that. And he said exactly what I thought he would say if they went 50, and that's that, hey, we went 50, don't expect more 50s anytime soon.
Brent, let me ask you just about, you've been so good about saying that you see warning signs, there have been things that are making you nervous about the state of this economy. This was a confident Fed chair speaking today about the balance of risks, about the jobs market, feeling like this is the moment. They aren't behind the curve. He was emphatic about that. Didn't want this to indicate that they felt like they maybe missed something back in July. Has today's decision caused you to reevaluate or see in a new way any of those things that were giving you pause or concern in the run-up to today's meeting?
He has to be concerned about the labor market. I remind you that at Jackson Hole, he said, and drew the line in the sand, we neither seek nor welcome any further deterioration in the labor market. And so why did they cut 50 basis points? They cut 50 basis points because the labor market has been weakening, except for non-farm payrolls, which they continued to point to as the one shining light in the employment picture. That was had cold water thrown on it with the 818,000 downturn. And now you're at less than 100,000, or right about 100,000, which is in the margin of error on non-farm payrolls, while the rule they created back in the day, the SOM rule, has been broken. And so to me, this is the Fed clearly worried about the labor market and worried that they may be too late to actually cutting. And that's why they decided to take 50, not 25. And that still remains to be seen whether it's too late or not. Look, I just don't think that that the Fed is going to land this perfectly. And that's where I'm a bit fearful in the market, because it is priced more so that they will.
Yeah, I just asked a gymnast. It's not easy to kind of hit a perfect landing. Brent, let me just follow though. The equity markets, we saw quite a rally initially after that 50 basis points. I get that, but we've really pulled back on that. What does it mean for the financial markets, the equity play in particular?
Well, I think it was probably a bit of buy the rumor, sell the news. If you think about it, we had those leaks, or those perceived leaks, on Thursday and Friday of last week, and then maybe even Monday of this week. And so I think it was a little bit priced in already. Look, to me, I think there's a regime change going on underneath the surface no matter what. And this is where we've been pointing to optionality in asset classes like small and mid cap, which I think were already priced as if there might be a recession. One way or the other, despite recession or no recession, soft landing, we thought interest rates would be lower because we thought the Fed would have to lower rates to either affect that soft landing, or if we had a recession, rates would go lower because the economy is looking like it's at a tipping point. And so to me, that's where small and mid caps, they started rallying versus large caps, or even the Mag 7. July 11th, which is the day after we had a CPI report that was weak, and a jobs report the week before where it was closing in on the SOM rule. And so that's where I think there's opportunities for investors who are willing to look past any near-term volatility. It's just in asset classes that people don't want to own right now. But we think those are the path forward for investors.
Ira, in the minute we have left here, what is your reaction to what we saw in markets over the course of the last hour? I was struck when Tom Keene asked Bob Michael of JP Morgan just about what he's watching for. He said kind of automatically credit spreads. That's where his eye was headed. How about for you? What stood out to you in terms of reaction over the course of that meeting and press conference?
Well, as a rates strategist, I have to talk about the Treasury market and what's gone on in rates. So, the fact that we bear steepened a little bit, I think, suggests that the market was more or less prepared for a 50 basis point cut. But importantly, they're worried that maybe the Fed's making a policy mistake, at least a little bit, right? And I suspect that once the dust settles, we're basically going to have very little movement in the long end of the yield curve. But two-year yields are probably going to continue to drift lower as the Fed continues to cut interest rates. So you get that bull steepening we've been talking about.
Before we go, real quickly, guys, first to you, Brent, 10 seconds. What's your next focal point in terms of the markets?
I mean, I think it's all about inflation and the unemployment rate. Where do we go from here? And is the Fed too late? I don't think inflation is dead if the Fed actually does go too aggressive. You're still late in an economic cycle, and the unemployment rate is still low, even though they've wriggled a little bit more slack. And you're seeing wage pressures pop up still around, such as Boeing and Amazon raising wages in the past few weeks, or trying to. So I think that's still out there.
Ira, 10 seconds for you. Next focal point.
It's the same. It has to be the economy, right? All of the main things that we look at.
I feel like bottom line, we're still data dependent. I mean, does that ever change?
Meeting by meeting and data dependent. We have the same clarion every meeting.
Jay Powell, right? Very clear on that. So appreciate it. Ira Jersey of Bloomberg Intelligence, Brent Schutte, of course, over at Northwestern Mutual.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, this story definitely catching our attention. It's a Bloomberg exclusive, a most read story on the Bloomberg about the billionaire hedge funder, one of the best known names, I would say, in the hedge fund universe. Dominated, David, the industry for 3 decades. He's had some very public ups and downs. Owns a major sports team, and has even been brought to life in a streaming series.
Yes, Steve Cohen, who currently runs Point72, announcing he's going to be stepping away from sort of day-to-day trading at the firm. And Kathy Burton has written about that for us here at Bloomberg. Kathy joins us now in the Interactive Brokers studio. Kathy, great to see you.
Nice to see you.
What prompted this move? I mean, I was saying to Carol earlier, he's done this before. He's threatened to do this. He's walked away from day-to-day trading before. Why now? And is this time, do you think, different than in the past?
It's really hard to say because he has done it before. He said, okay, I'm not going to trade anymore, but he is very much an animal of the markets and always has been. And so it's possible that if things get really crazy around the election, he could step in again. But I think really the idea is that he thinks that he does more good mentoring people, doing working with other traders than doing his own book, especially because the firm is so big now.
Does his investors agree with that?
Yes, because I think over time,
the next generation?
He's been cutting back.
Okay.
Like even a year ago, this time of year, he apparently was trading less than he had before. So, and people are pretty happy with the performance, and so they think it's big enough now. There's enough teams. It's not like just old school SAC when he was running the show.
For those who don't know, how big a firm is this, and sort of how much is it him? How much is it Steve Cohen's firm? How much influence does he have? I know it's a co-CIO position. What's the relationship like with the other CIO, and sort of how much has he been running it and calling the shots?
Well, I think if you go back to when it was SAC, he was calling a lot of the shots. It was his firm. But now I think he really does it. Like his portfolio would have been a tiny percentage of the $35 billion that they run.
I was going to ask how big the book is. I mean, is it a big?
Yeah,
big, relatively speaking, I suppose.
So if he's doing, $1 billion or something, that's still not that much percentage-wise of $35 billion firm. And I doubt it was even that large, but.
One of the things I love about your reporting is that you remind us of kind of who he was, and even as a kid. I mean, he does really love to trade, which kind of goes from how we started, that, you do wonder if he'll be drawn back into it. Remind us kind of about who he was even as a young kid and his kind of love of the stock market.
Yeah, well, we were told when we wrote a profile of him back in the day that he would, when he was at Wharton, he would actually leave class and go and just watch the tape.
He'd skip class to do it.
Yeah, and he just got a feeling of how stocks would move.
There was this period when there was a settlement with the SEC. He stepped back. He wasn't managing money for
Not
for
so
2
great.
years. No. What was that like? What do we know of what that was like for him? And sort of, I mean, you hit on this in the story. It is a remarkable renaissance here to go from that, and he was never himself charged with anything or tried, but to have that kind of rebirth, how astonishing is that? And how did he manage it to do that?
It is astonishing. Yeah. I mean, I think it helped that even when he opened the doors again, he's had $10 billion, which is a pretty big amount of money. It was all his.
Yeah.
And then over time just started to replace it. It took him a while. I think initially it was more individual wealthy people, and then became more institutional even over time. As more time passed, he got bigger clients. And that's how he got to $35 billion.
He's been such a dominant force in the industry, but he's not necessarily somebody, right, that goes on camera a lot. He's very quiet, right?
Yes, yeah. He's not someone like Bill Ackman who goes and is tweeting every day. And I mean, the only first time he went on social media was after he bought the Mets.
Right.
And it was all about baseball.
Well, what does it mean kind of about, you say he's 68 years old. Like I do think about, he did buy the Mets, right? Like where he is in his world, that maybe this time of stepping back is something more official because he's thinking about, I don't know, you do get to a point where you get older, you're thinking about, okay, what's left? As one guest once said to me, you start to count, how many more summers do I have left? And I do wonder, you're much more familiar with him than most of us, like what he might be thinking.
Well,
or am I thinking too much about this?
I do think that he's still very, very involved in the business. I mean,
Yeah.
I think the co-CIO thing is for real. It's just this maybe the minutia of the markets. That's the thing that he's stepping away from. Yeah. And like I said, even people who know him very well say he said this before.
He's such a well-known name and figure, and there's a line in the piece that jumped out to me. You said this move is a litmus test to determine whether multi-strategy firms can thrive beyond their legendary founders. You invoked Bill Ackman a moment ago. I mean, there's a handful of people like this, well-known hedge fund managers. Talk a bit more about kind of the overall symbolism or importance of this for the industry. Again, there is this group who have been in the business now for many decades. I'm curious, sort of, is there much in common among all of them as they think about what the future might be? As we've seen some step back, how's that gone in the past? And how difficult is it to move away from being such a name brand, is a crass way of putting it, but being so associated with a particular firm?
I think that actually, for Point 72, it would be easier if Steve went away completely, which, as I said, is not, he's still super involved. But I kind of somehow see that at that firm, it might be easier than at a place like Citadel, where Ken is such a big part of that firm.
Really?
Yeah.
Because I always think he's just so, Cohen is so identified, right, with the success of his firm.
No, but because I think the whole experience that happened of restarting again and becoming much more institutionalized, and that was only 10-ish years ago, right?
So, I want to ask you if you could sit down with Cohen right now, or maybe you did. You don't have to reveal. Like, what is top of mind for you about kind of what you would want to know from him?
I would like to know whether I kind of doubt that he's going to stay away from trading. So I would like to ask him what would bring him back.
Yeah.
And if he, the whole idea of buying the Mets and being super involved in the bets and caring about that, if he could imagine a day when he would just leave the business and focus on other things like baseball.
Which I would like to do as well. But
fair enough.
You having covered SAC and Point72, I think a lot of the criticism and indeed like scrutiny of SAC was about the culture of that firm. How different are the two cultures of these places? So in that reinvention, yes, it was kind of building it from the ground up if the ground is $10 billion, but how different are the cultures of the first shop and this one? How has he kind of changed the way that they this one operates versus that one?
Well, Steve was definitely much more involved in the first one in trading. He sat in the middle of the trading room and talk on the microphone all day. And he was very close to all the people. I remember someone telling me a story of one guy who worked there for years coming home, and Steve was on his couch, like watching golf.
Oh my God. Are you serious? How does that happen?
So he was like, this is really, really back in the day when it was a small firm.
What?
Carol can't get past it. I don't want our bosses to get any ideas.
There's
either.
A book here about the inner working.
And now I think it's a place where there's so many more people.
Yeah.
Yeah.
And I mean, they were really a band because when he left Gruntel and started his own firm, it was a handful of people. Mm.
I said that, he was the inspiration for, I don't know if there was the inspiration, but certainly anybody who watched Billions, right? Yes. We were like, Steve Cohen, just got 30 seconds left here. I mean, watching that, do you think they got a few things right in a big way about Steve Cohen?
No, I think that...
Did he watch it? Do you know, since you do have conversations with Steve Cohen?
I stopped watching it a few seasons ago.
Did Steve Cohen watch it?
Oh, did he watch it? I don't know. He must have looked at it. Or some people who know him must have looked at it.
Yeah.
But that's really more of an amalgamation of so many stories from the hedge fund industry.
I know. We just like to make that jump, the inspiration. Kathy Burton, thank you so much. Bloomberg News hedge fund reporter Kathy Burton, as we said, an exclusive and among the most read on the Bloomberg. And maybe he'll come back. Maybe he won't. Maybe we'll have another story like this in a year.
The magnetism of the computer draws him back.
Oh, my God.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We want to get to what one thing Bloomberg Businessweek is so well known for. It's closely followed and often cited ranking of business schools.
Yes, it's out now.
Did you go to business school?
I did not go to business school.
Okay.
I don't know that we can talk about that. Is it worth me going to business school? We'll decide this afternoon. Dimitra Kessenides is with us here in the studio, and maybe we should start with just like the methodology. Sure. This is your world. You're immersed in it. There are other rankings of business schools. I'm breaking no news there by saying that. How is this ranking, this methodology different? And sort of what are you looking at?
It's a very complicated methodology.
Don't give away any trade secrets.
I will distill it down to the few key points. Several of the other rankings also do this, but we survey students, alums, and employers. We combine that with data that the schools also report to us. So we are taking in a lot of data. We're not going out there and seeking it out. And we combine all that data with a variety of formulas that fall under 5 indexes that we've developed.
And what gets the greatest weight?
Compensation, for example, is one that gets a lot of weight and more than others because compensation, people misunderstand us when we say this. They think we're saying it's the only thing that motivates B school students. No, it is not the only thing. But when you talk about the fact that you want to grow your career, you want to go into leadership,
yes.
Even if you're making a switch, even if you're looking in nonprofit or social impact or what have you, growing your career and expanding and being a leader means you're probably going to make more money, and you're looking to do that. You're spending a lot of money on business school. You do want to be able to recoup that expense also. Which, by the way, we have a new tool that helps you do that.
I love this.
Assess it, our ROI tool. We could talk about that another time.
I flagged it yesterday when this came out. I thought that's amazing.
But that is a very quick look at the way that we do this.
Having said that, and having worked with you guys over the years, it feels like the number one spot, it's really hard to unseat the one who seems to keep coming back.
Stanford.
It's very pretty.
It is very pretty. It's in a great place. We have these indexes that it just consistently is doing very well on almost all of them. Especially entrepreneurship is a real big standout for Stanford. Learning is a real big standout. They benefit from the people in the tech industry and other industries that are out there, from many entrepreneurs connected to the school, teaching at the school, alums of the school. It is a place people want to go. I think they, rightly so, sense that they are going to do quite well if they go to Stanford Business School. But many other schools also offer a lot, and it's hard. I don't know how to answer that question. We're all waiting for the year when Stanford won't be number one. Stanford, nothing against Stanford, sorry, don't. But
it's going to be frustrating for some of the other schools that are out there, right?
It can be. If we look at the numbers and we really break it down, though, the differences among the top 20,
does it matter?
Very small numbers. And at the end of the day, use an ROI tool, but think about also we have profiles that are rolling out later this week that are in Business Week's issue, October issue. And we talked to recent grads about really, why did you go? What was it about this degree that you felt would be useful? And the theme among them all is that they really stopped and carefully thought, this is the career I'm going after. I'm missing these skills. How might I get them? What's the fastest way I'm going to get those skills? Will that enable me to maybe get the job I want? I'm going to business school. If you can't answer certain questions like that, maybe business school is not for you.
Are administrators able to do that? I mean, over the course of doing this, you talk to a lot of leaders of these institutions. There's been some turnover, as you know, in the leadership of some of these business schools. How do they answer some of those questions? I know that a big issue is it's a huge commitment. Carol asking if I'd gone, I don't think that I could go now for 2 years full time.
Give up,
and give up whatever.
But here, David, the good news is that so many of the schools now, driven by the modifications they made and the innovations because of COVID, decided, you know what? Flexibility is something people really like. So we can break up. We do still have a full-time 2-year program, but if you, David, would like to do something that's part-time, that's very specifically focused on, let's say you really are, you want to become like a data analysis whiz, and the specialty programs are the ones that have done very well. How can the schools answer those questions? The schools can't, but the schools are very focused on trying in the recruiting phase and then when they're going out and talking to prospects to really get people to get to that point where they're grappling with those questions and answering them, because I don't think the schools want students that don't know what they're doing in the program, and the students definitely don't want to be there if they don't know what they're doing in the program.
The number of folks who are going after MBAs, up, down, same?
I would say it seems to me about the same, and it depends on where they're coming from. We've had some issue with U.S. applications being down over the last 10 years. We did a big story and analysis of that just about a year ago. Those numbers are slightly up now. International became a very big focus at many schools in terms of recruiting and how they're going to keep up the level of selectivity while not having to expand how many people they're accepting that don't quite have the qualifications they want. But I don't think there's been a huge dramatic difference in recent years, and I think some of what we're seeing is, again, ways of addressing what the students want that maybe is appealing to people and making up for that.
We're short of time, so we can't get into this ROI calculator, but it's very cool. It's on the site. Everyone should check that out. And then also, we didn't get into, you look at international schools as well. So this is not just a U.S.-focused thing. And 30 seconds left. I mean, that's challenging, but you do yeoman's work.
Yes. Well, it's a lot of work, but really hats off to the data analysts on the team here that are doing the hard work in this. And then we're out there talking to people. International indeed. This year, IMD, you had David Bach in here. I don't know if you recall that. He is the newly sort of installed leader of that institution based in Lausanne, Switzerland. Look him up. Look up the interview that Carol and Tim did. Look at what they're doing.
And you did with us.
Oh my gosh.
Well, did I talk to him? I don't know, but I talked to him after. Yeah. Very interesting person who features in our story also about how CEOs should avoid the traps of our very highly politicized world right now.
Dimitra Kessenides, great stuff as always. Bloomberg News senior editor. Check it out online on the Bloomberg in the new issue of Bloomberg Businessweek.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.